not happening. Good evening, and warm welcome to all Scotiabankers, colleagues, Ivey Business School alumni, and guests. Thank you to everyone who played a role in organizing this event. My name is Doobie Cunningham, and I'm the VP of Enterprise Innovation in Digital Banking at Scotiabank, and I'm truly honored to be here. We are so delighted to host the third annual Scotiabank Speaker Series in Digital Transformation Banking in partnership with the Scotiabank Digital Banking Lab at Ivey Business School. As you know, technology is rapidly changing the way we are experiencing the world. In 2008, there were more things connected to the internet than people. And by 2020, the amount of internet-connected things will reach 50 billion. Mobile phone usage is also fueling connectivity, with over 78% of global consumers now owning a smartphone. And in Mexico, 34% of these consumers are using their phones to make payments. In Canada, we're seeing 17% of consumer adoption and growing. What does this mean to us? Our customers are demanding simple and seamless experiences, and we are responding, which means we are laser focused on providing a leading digital customer experience. Our network of digital factories, including one in each of the Pacific Alliance countries of Mexico, Chile, Colombia, and Peru, and here in Canada, are designed to facilitate collaboration, creativity, and real-time direct customer input to develop innovative solutions. These factories will serve as incubators for new products, services, and solutions for Scotiabank's over 23 million customers around the world. Additionally, we continue to invest in the development of technologies that are transformational for the industry, including artificial intelligence, machine learning, blockchain, and distributed ledger technology. Scotiabank is making key strategic investments in technology and fintech partnership as part of our strategy. I'm happy to report that we have dozens of these partnerships around the world, not only in Canada, but also in our Pacific Alliance countries. The bank has made an investment in R3, a financial technology fintech company focused on blockchain, and we are seeing a lot of collaboration in this space. Scotiabank is one of more than 80 financial institutions and regulatory groups working with R3 to develop this technology. Technologies such as blockchain are important to Scotiabank and the industry as a whole. Platforms range from public to private, with most of our work focused on private networks. We are seeing the value and efficiencies blockchain can bring to our business environment, and we are excited to see what it brings, what is on the horizon for this technology. And we'll hear more about that from Ryan. So you know you've made it when you have an intro and someone else introing the intro. Scotiabank has a long-lasting relationship with the Ivey Business School. Throughout this past year, the bank has collaborated with Ivey on research projects, hackathons, and speaking engagements. Key elements of our partnership include providing opportunities for research and applied learning in fintech, blockchain, and distributed ledger technology, topics that have been a cornerstone of student engagement this past year. These topics are at the heart of our joint research efforts, and we are seeing the positive results. The Digital Banking Lab has participated in over 20 research talks this past year at leading universities across the world, contributed to more than 10 publications. See, some things do get published. Spanning research articles, practitioner papers, and teaching cases. And the first doctoral student, supported by the Scotiabank Lab, completed a dissertation on blockchain in the field of management. Through Ivey, we are connecting into the ecosystem and hosting events like the International Scotiabank Case Competition last March, Hack Western, which took place in November, and Hack the Case back in April. And we can continue to build ongoing connections through the Ivey FinTech Club. Blockchain is a topic that has been central to our outreach efforts as well, as tonight's speaker series illuminates. Never before, this is a quote from my boss, never before has there been such an exciting opportunity for banks, academics, and fintechs to collaborate and build a strong ecosystem, shaping the future of banking and creating a strong, healthy economy. On this note, it is my honor to introduce to you a key mentor of the Scotiabank Blockchain Lab, JP Byrne.
Good evening. Thanks for your introduction. Duby, you've been with us, I think, at every single speaker series event so far, so thanks for your continuing support. We really appreciate that. So it's my pleasure to welcome you to the Scotiabank Speaker Series in Digital Transformation. It's a project that is part of a generous donation from Scotiabank, and we're really thankful for that. In the past 2 years, we've had high-profile speakers as well. We had our first speaker was Ray Sharma from Extreme Venture Partners, who gave a talk about fintech innovation in Canada and across the world. That was 2 years ago. Maybe some of you were there. Last year, we had Dino Trevisani, who's president of IBM Canada, and who gave a talk about cognitive banking. We are pursuing this effort with our third series tonight. Our speaker today is Ryan Zurrer. He's a principal and venture partner at Polychain Capital, and he will be talking to us about the future of blockchain technology and the future of the web. I'll tell you more about him in a few moments, but I'd like to give you some guidelines about how the event is going to unfold. So Ryan will have about 30 minutes to talk to us, and then we'll have plenty of time, probably about 45 minutes for Q&A. We'll be running this event in a digital fashion, so you can follow the conversation on Twitter using the hashtag cryptoeconomics. And you can submit your questions to Ryan using the hashtag AskRyan on Slido. So you can connect to this website if you don't have the app. And it's very simple. You just enter the hashtag and you'll be able to ask your question, and we'll take all the questions from an iPad that we'll have a bit later. Feel free to hang out after the talk and the Q&A. We'll have some time if you want to network and say hello to your friends. I hope we will get a lot of interaction on Twitter and Slido tonight. I'm sure we will. So now I am pleased to welcome our guest speaker. Let me say a few words about his background. So Ryan is a graduate of Ivey's HBA program, 2006, where he played varsity men's rugby. He's now principal and venture partner at Polychain Capital, and in this role, he's leading private investments in blockchain projects. He's been an active angel investor in the blockchain space since 2012, backing both startups and token-enabled networks. He was an early investor in Bitcoin, in Ethereum, in MakerDAO, and other blockchain projects. He actually ran a Bitcoin mining operation in 2013 out of Brazil. Prior to joining Polychain Capital, Ryan was a CEO of a Brazilian renewables firm. He also has extensive experience building large-scale projects and evaluating emerging technologies in multiple countries, and he's been working in China, Singapore, Denmark, Spain, Canada, and Brazil. Prior to his time working in renewables, Ryan worked in investment banking, focusing on financial technology. Now, please join me in welcoming Ryan Zurrer.
Thanks very much, GP.
I think I have one.
If I'm not mistaken. Cool. So thanks very much to JP, to my alma mater, Richard Ivey, and obviously to Scotiabank for putting this on. I'm very grateful and honored to be selected to come and chat with you guys, and I'm also very grateful for the time that you're all taking out of your busy schedules to come and jam with me on crypto economics and Web3. So crypto economics is actually something that was born right here in Canada. It is a concept created by Vitalik Buterin, who's the creator of Ethereum. And I like to tout quite often whenever I'm speaking or talking with people around the world that really the emergence of crypto economics and kind of blockchain 2.0 started right here in Toronto. And we should be very proud of that as Canadians. I think it is probably one of the most compelling innovations that has been created by our country, certainly in a generation. And so we spend most of our time talking about crypto economics at Polychain and sort of jamming with different teams who come in from all around the world and just want to build different crypto economic systems to drive behaviors on different networks. And I use the word jamming as kind of a deference to music creation, because to build a really compelling crypto economic system, you need different skills. And so I'll get into that in a second, but just to start with my attempt at a definition of crypto economics, because while Vitalik created it, he didn't really define it. It's how we use digital incentivization, digital forms of incentives, which can be tokens or other things, to drive specific behaviors and specific resources on decentralized networks, thereby delivering security and accelerating network effects. And these two things are really the holy grail that we're looking for when we're creating crypto economic systems. The emerging academic field of crypto economics, which I'm very excited that Ivey will be a leader in going forward, is really this amazing convergence of all of these different disparate fields that really never had touched each other until now. So it's cryptography and behavioral economics. There's law and math and game theory to think about, distributed systems, network security, but then also just some deep group psychology items to think about that we'll get into, and obviously finance involved. And this is why it always has to be jammy. You need more than one person's skill. I know no one on the planet who has all these skills. And so while we're trying to develop young talent that has the majority of them so that they can create crypto economic systems on their own, in today's generation, we need to bring together different people with different skills in order to come up with these systems that are secure and robust, that sort of follow the rules of behavioral economics, as well as math and security, so on and so forth. And this is why it's really nice to have all these people come in from around the world and jam with us at Polychain. So the aha moment here is when tokens and a crypto economic system is designed correctly, you can accelerate network effects like rocket fuel. There's something strange about adding incentivization into communications in, say, a social network that makes people very passionate and sort of very focused on delivering what the given resource or given behavior is that is required. We see this with Bitcoin, with the block reward, and how just that one block reward for providing computational resources and confirming transactions drove an immense amount of computational resources to securing the Bitcoin network. So much so that it's on the order of 30x the amount of computational resources available to Google today, just to confirm transactions on this network. It's probably gone a little bit overkill, but what we see is very, very intense acceleration of network effects. One kind of anecdotal piece of evidence that I use for this is other companies that we've seen that have come before, or projects that have achieved network effects, don't really have the passion that we really see in these crypto economic systems. I've never in my life seen a Facebook or Uber tattoo. I've seen hundreds of Bitcoin and Ethereum tattoos on people. They get very passionate about this space. But within designing these kind of crypto economic systems, I like to sort of separate it into 3 layers. So there's a transactional layer of consumers performing normal everyday transactions to sort of achieve some output that they want. There's a utility layer, which can be confirmation of these transactions, or maybe it's providing some resource like storage or computational resources to a network. And then we're starting just in the last few months to see this emerging 3rd layer, which, by the way, my original post and concept on keepers did not actually take into consideration this 3rd layer, which is this sort of policing layer. So we get these validators, but then the validators of the validators, so that you have even more security on a network. And the idea behind keepers, when I first came up with it, was the fact that Bitcoin was interesting, and the miners confirming transactions, this was a very interesting phenomenon that happened. But what we're seeing is, we're seeing it emerge beyond just confirming financial transactions. And one example I like to use is Filecoin, where the mining of Filecoin is providing storage to a network. You offer storage, and somebody else can store their files on your device, or many people can store small slivers of their files on your device. You get paid in automatic transactions for your excess storage, which didn't cost you anything anyways. How much excess storage do you have on your laptop, on your computer, on your cell phone, so on, that you could monetize? and other people are able to use that excess storage at a lower cost than they would otherwise pay. And so just confirming transactions, just the mining, wasn't really enough to encapsulate everything that's happening at this sort of utility layer. We have provision of storage, confirmation of trust, we've got reputation networks, and different things that are coming up. And so I call them keepers as this catch-all of this utility layer of people who provide a service to a network that users will use, and they are then remunerated by that network. The great thing here, though, and this is really where crypto economics comes into play, is they don't need to necessarily be remunerated by the users. So if I'm using a storage network like Filecoin, I don't actually have to pay very much for my storage because the system has this thing called a block reward. And the people who are providing storage are only interested in that block reward. So every few minutes, a bunch of Filecoin are minted and provided and sent to the people who are providing storage on the network. They don't care about your transaction fees because they're more interested in that block reward. And what that means is if I want to store files, or if you want to store files on this network, it's not just a little bit cheaper than Dropbox or Amazon Web Services. It's basically free. And that doesn't compete with the existing systems, it obviates them away. And when we design these crypto economic systems such that someone providing a valuable service or resource is paid inherently by the system and doesn't need to charge users, we drive the cost to users to nearly zero. And that's very compelling. That was the original vision of Bitcoin. That has not played out, mostly because politics and human intervention and very unfortunate things have come up. But we will see this play out in other crypto economic systems. So Filecoin being one, but many others are kind of on the horizon. And this sort of using a block reward to pay for the utility of a network such that users get that network basically for free is very, very compelling. The police layer is something that is really new, created by my friend Gavin Wood at Polkadot. And this is just about making it more efficient to achieve security. So you don't need a lot of the sort of cryptographic security that is in early systems if you have another layer of sort of policing on a network. And then you add in another group of people who can be remunerated on these networks. These people operating on these networks will be the new types of jobs that we'll see across the world. So there are different types of keepers, and I must confess, this is an evolving list. I kind of came up with this as an initial list, but then I imagine there will be more types of keepers that we see. So you get resource transactional, that's where like storage or computation is given to a network in exchange for fees. You get gatekeepers of trust, where someone is a bonded, trusted member to say, confirm when transactions or transfers have been made, and if they confirm wrong transactions, then they would lose quite a bit of money, more money than they would gain from kind of trying to game the system. And then arbitrage keepers, which is the original sort of concept behind this, which is where different self-interested actors on networks will try to arb the network and thereby maintain stability. We see this with stable coins, where they're maintained as stable because people are trying to constantly arb the network, and so when it goes a little bit above $1, people will arb it, and then you'll see it kind of come back down naturally, and the same thing for a stable coin going below $1. And these are just different types of network actors that will be sort of workers that maintain the stability of these decentralized networks. One thing we've seen as a result of kind of tokenization, I'll just speak to very quickly, is ICOs and using this as a funding mechanism. I get a little bit dismayed with the amount that people sort of poo-poo this idea and say, well, it's filled with scams and things like that. And yes, of the $5 billion raised, some of it has been scams and so on and so forth. But it's really been an amazing mobilization of capital where, and the effects that it has created has been generally quite positive. So you get more retail access to very compelling ideas. You get very passionate communities and not just a single VC or two VCs behind a project. And that's the reason why this has very quickly outpaced VC capital deployment. It's more interesting for entrepreneurs, and because these tokens are liquid, it's also more interesting for investors, because for the first time you can take a risk-adjusted approach to early stage investing. Until now, if you invested in a seed stage company, you had to hold that thing until the company lived or died over the course of 10 years. And maybe it had a moment of greatness, but then ended up dying and you made no money in the end. Now you can kind of take a bit better risk-adjusted approach, and as there's sort of hype and excitement around a project, you can kind of take principal off the table or pare your bets back somewhat. And even if a project fails, you could do very well. And so it allows just again, a better risk-adjusted approach to early stage investing. And I think as a funding mechanism, it's been a very interesting phenomenon. And I used to say that blockchain would disrupt Sand Hill Road long before it disrupts Wall Street. And I don't really say that too often anymore because it's already happened. Sand Hill Road's a pretty quiet place these days. Another kind of crypto economic system that will, again, just talking a little bit more about the block reward. This is just a time-based or work-based reward that's given to utility players on a network. And we see that over time, it kind of decreases. So this is both Bitcoin's block reward and Zcash's block reward. My close friend, Juan Benet, who I credit with the return of the block reward. So we got away from block rewards in kind of like 2015 to about midterm last year. And it was really Filecoin that brought it back and said, no, the best way to incentivize these decentralized networks over the long term is to have a block reward, is to not necessarily ICO a majority of your tokens. So he ICO'd only 10% of his tokens, and the rest go to these people who provide services over the long run. And so while this is an interesting funding mechanism, you need to pair it back with a very long-term approach to who is going to actually provide value to your network over the long term. Another really interesting topic that we spend a lot of time on, I'm just going to sort of file through a bunch of different topics, is governance. Governance is a huge and very polemic issue in our ecosystem these days. And Polychain is squarely in the pro-governance camp. We think that networks that have governance, that have a way for the different constituents in those different layers to signal to one another what matters to them, will allow networks to evolve faster. The reason why Bitcoin has suffered from what is a classic case of innovator's dilemma, and subsequently Ethereum has also gone into kind of unacceptable level of growth and development, is mostly around a lack of governance. People fight for weeks, months, even years on end over a single issue, and the protocol doesn't evolve forward. If we have governance, then we have an ability to evolve things forward. And then within, say, Bitcoin and Ethereum, there's this concept that if you fork, if people don't like what's going on, then they can fork it. They can always take the code and go and do their own blockchain. So we've seen Ether Classic, and we've seen Bitcoin Cash and Bitcoin Gold in these forks. However, I think there's a genuine misunderstanding here that forks are a form of governance. Forks are a failure of governance, right? Like if we as a country, if a province in Canada forked out of Canada, that isn't the fact that our governance worked. It means it didn't work. And so I get very sort of dismayed at the idea that we don't need governance because if people don't like it, they can just fork. Then we're going to get into this balkanization of the industry, which isn't really healthy for anybody. But governance is really, really hard. We have to remember that we exist in highly adversarial environments on chain, pseudo-anonymous, there's tons of hackers. And in order to have an appropriate governance system, it needs to probably be grandfathered in over time. The examples that we have of governance up to now, which I've been fortunate or unfortunate enough to participate in very, very directly, like the DAO and BitShares, have largely been catastrophic failures. The DAO, if anybody can look it up, it was an absolute failure of $160 million that was totally lost. Some of it was gained back. But what happened there was we didn't achieve quorum on minimum decisions. And so governance just needs to be evolved over time. You need to have a participatory community. It can't be just pure speculators. You need to have people that understand issues and participate in the issues in order for governance to matter for for chains. And I think governance is really like the big hot topic of 2018. You're going to see some amazing things come out of governance from 2018. I am cautiously optimistic that we'll see a DAO 2.0. So the DAO, anyways, just so that everybody knows, was this like large VC capital pool that would make deployments based on everybody's voting. Polychain would probably not exist today if the DAO had not failed. And we actually support that there's a DAO 2.0, and we think that that could be a really interesting way to deploy capital going forward. You'll see different governance raids. So we had a problem with a governance platform of ours named Tezos, and we orchestrated a pre-Genesis raid where we had to fork out one of the founders because he was just a tyrant that was trying to steal all the money. And it is a really interesting sort of thing to play around with is that social consensus and governance will trump sometimes what is sort of written in code or written in law. The concept of major ecosystems is another thing that we're jamming a lot on at Polychain. These are layer 1 protocols. And so we think that there maybe won't be dozens of layer 1 protocols, but there will probably be somewhere between like half a dozen and 10. And they'll have some very specific consensus mechanism improvements. And they offer this rich topography for decentralized application developers. We're excited about Polkadot, Tezos I had mentioned, Filecoin I've mentioned quite a bit, and Dfinity is another one. And these are kind of very compelling innovations that will allow for many people to sort of build different things on top of them. And again, there won't be many of these major ecosystems. They require incredible resources and talent to build and innovate, but there will be some. And there won't be one. There's sort of this idea that there will be one chain to rule them all. We do not subscribe to that, and I think there's good reasons not to. There will be more than one, but not dozens. Meta protocols is another concept that we spend a lot of time on. And this is where a tool can be applied to different major ecosystems. So for example, one protocol is more useful because it's on Ethereum and on Dfinity and on Filecoin than if it was on just one of those. It gains further security and gains further network effects because if I'm a keeper on one protocol, I can get revenues in different tokens. That makes my revenue stream more stable, and that makes for a more compelling business overall. And so for these people who are building these specific use case tools, often a meta protocol approach is kind of a successful path. And we're seeing more projects realize that it takes a tremendous effort to be a major ecosystem, not so much to be a meta protocol. And if you have an interesting, compelling innovation, you can partner with the major ecosystems, a number of them, and really have outlier success. And so we sort of push a lot of smaller teams and newer projects into this concept rather than the major ecosystem concept. So just some other examples and ideas that we're kind of playing around with at the office. We remain in the infrastructure era for the time being. So if we think about blockchain as like a stack of technologies, the way we could have thought about like Web 1 or Web 2, where protocols like TCP/IP and HTML sit at the lower part, and then applications sit at the higher part. We still need this infrastructure layer to be laid totally in blockchain before we can start thinking about applications. So when people are talking about like chat apps and things with high frequency transactions, they're not understanding that like they're talking about, building a Tesla, and we don't have roads yet. And so we need to like worry about infrastructure, airports, roads, highways, things like that before we get into the apps. The other cool thing about this is actually the roads and infrastructure are far more compelling and far more attractive financially than the applications. One example I kind of use in this is HTML, which is a protocol that was made in the early 90s and sort of still regulates a lot of our email. If you could just dial in a little mechanism that made it so that for someone to send me an email, they have to pay 1 cent, or even half of 1 cent. Spam would go away overnight. And it's absurd that in 2018, we still have spam. I still get a dozen spam emails every single day. And we haven't fixed that yet. It seems like we should have fixed that by now. And part of the reason why we haven't fixed it is it's not fixable at the application layer. You have to fix it at the protocol layer. You should not be able to communicate with another node on the network if you don't, say, pay the relevant service fee to do so. And if we could add in those financial incentives at this base infrastructure layer, then you can kind of fix a lot of the problems that we see in Web 1 and Web 2. Scalability is a huge problem. You can, as I mentioned about sort of chat apps, you can't have, say, high-frequency transactions on normal blockchains today. There's a lot of smart people working on these issues, and we'll see some really interesting innovation. But this is a little bit longer-term time horizon than most people think. This is getting scalability right will be measured in years and not months. And even though it's really the fastest evolving space that I've ever seen, or industry that I've ever seen in the world, it will still take some time. These are very difficult challenges. And then again, going back to that original slide, it requires input from a lot of different fields that need to communicate with one another. And then we're going to start to see a lot more communication between chains. And this is something that Polkadot enables, where today there's kind of this silo thing, where if you are doing transactions on Bitcoin, you can't really talk with Ethereum, and Ethereum can't really talk with Tezos or anything else, and there's this like sort of walled garden siloed effect. And now we're going to start to see chains directly communicate with one another, and that's really, really interesting, because then we're going to start to see chains directly compete with one another and directly raid one another. And we're going to see this like second coming of kind of the barbarians at the gate, which we call network raiders. And I'll get into that in a little bit. Some different market trends. So WebAssembly seems to be where everyone's moving. I can talk with people offline after that if that's interesting. But WebAssembly virtual machines is something that we noticed, and this just came from our kind of unique position in the market. Different sort of very smart portfolio entrepreneurs arrived at the conclusion that compiling to a WebAssembly VM was the future, and they arrived at that conclusion totally independently. They were not really talking with one another. So Dominic Williams, the brilliant inventor of Dfinity, and Gavin Wood, who co-invented Ethereum and has now invented Polkadot, and Juan Benet, who invented Filecoin, and even some of our guys out in Asia, they all came to this conclusion independently and then shared it with us. And we were sort of the first ones to say, wait a second, all these really smart guys are coming to the same conclusion that WebAssembly is the future. And so we've made this a big focus of our fund in 2018. Projects are doing fewer token deals right now, in part because there's a lot of regulatory concern that I'm sure we'll get into in the fireside chat, and doing more sort of early stage equity deals and being very patient with the tokens. Obviously, the crypto market is down on the order of 70% since January. And so we're going through this trough of disillusionment where people are understanding that it's actually, even though we're moving very fast, it's still an order of magnitude away to get consumer level applications and real scale in this space. And then many new attempts at layer 1 blockchains, which I would say mostly misguided. I mentioned a little bit about network raids. And so this is a concept that I've never shared publicly before. And I just would like to preface by not saying that we don't necessarily support network raids directly. We just think it's an interesting, inevitable evolution of the space. And so you're going to see some networks raid other networks and take their users, or raid other networks and and find an exploit. We are very fortunate at Polychain that two of our what we call our young Jedis have found exploits in 2 top 5 coins in the last few years, in the last actually 18 months, and sort of negotiated a very interesting kind of bounty, as I'll call it, and sort of leave it at that. But we are starting to see the early emergence of network raiding. When you have a token that doesn't make sense on a network, kind of like the Raiden token, that's just going to get forked out, right? People are not going to have efficient markets where they're going to allow this token to just rent seek on top of it. And so we're starting to see that, and we're seeing it in, incidentally, a network raid of Raiden right now by Ethereum. Ethereum is trying to raid the Raiden network. The governance fork, so this was something that we did with Tezos, where we just saw that one of the co-founders was trying to make off with all the money, and so we forked the whole network. And then he gave up, we worked out a settlement, and I thought that was really positive for that whole community. And then you'll just see like hostile chain takeovers, so we're seeing Ethereum right now sort of take over Dogecoin through the TrueBit bridge. And that's, that's really interesting. And this chaos, within this chaos of different networks raiding other networks, we're going to see amazing value creation, frankly. For those people who are prudent and agile and are able to sort of be on the right side of technology and on history, I think you will see some incredible wealth created over the next few years. Crypto financial primitives is another really cool thing. So this is doing like swaps and derivatives, collateralized debt, which allows for stable coins, derivatives on gas tokens or on mining tokens, where you can take, say, like a group of miners and basically securitize that down and tokenize it, and then sell those tokens that have like a dividend, and that looks like a fixed income product. All these very complex financial derivatives that we're seeing pop up is really compelling. And this, for me, is the big like aha opportunity, because people talk about, oh, Bitcoin could substitute gold or something like that, and that's like a $5 trillion business. Well, who cares? Because derivatives is a $500 trillion business. And so to the extent that we can create more efficient, higher frequency transaction derivatives that are based on very compelling points that can allow people to hedge bets in the real world, like weather or things like that, I think there's obviously an amazing opportunity that exists there. And we're starting to see a lot of really smart people jam on these concepts. So other sort of like just different ideas that have come up. I came up with this idea actually in early 2000s on a sports DAO, where you could create, if you took, say, a privately held team and then tokenized the ownership and then had fans contribute to decision making, say that you had fans contribute to like scouting or drafting or even like lineups before a game or things like that, but then they were penalized or rewarded for how good their input was, you would maybe get to a situation where you have better decisions in a sports franchise. And even if you don't get better decisions in a sports franchise, you dramatically improve fan engagement, which would dramatically increase your revenue per fan. And so I've been actually really touched and honored that there's a number of ideas floating around of people who are trying to acquire some sports franchise or start different leagues sort of using this concept. But this is sort of what we see in kind of like real world context, where we can use tokens to drive incentives among people, reward people for doing good things, penalize people who are not doing good things, and then kind of filter out a system such that you have better decision making over time in a decentralized network. This is really powerful, and I hope that it has as big of an impact on sports as it does on governance and law and commerce and so on and so forth. In a former life, I built renewable energy systems, and I was always very dismayed at the renewable energy credit system, which requires consultants to just arbitrarily state that X project either consumes Y amount of renewable energy credits or produces them. And then there was a lot of like indirect or sort of like just incorrect incentives in that consulting sort of practice. And so this was a system that I came up to basically police this layer of consultants around the world so that they don't over allocate renewable energy credits to projects that aren't actually producing enough of an environmental impact, and they don't under allocate renewable energy credits to consumers that are producing sort of too much impact or consuming too much impact. And I'll leave a link up here, but this is sort of just like how the system works visually. I don't think it's really the forum today to go through it all, but it's pretty simple, and then you can kind of understand different ways that you can maintain trust and police actors within a network, right? Today, these consultants all around the world dole out these renewable energy credits as they see fit. And there's no checks and balances. And really, this is what crypto economics can do very well, is put in place very interesting checks and balances within distributed networks of actors, and use reputation and monetization in order to sort of control that. Leaving you with a couple of things. It should be remembered that this is really Vanguard technology. We've seen some very big blow-ups. We're going to see some other ones going forward. And we just like to say that we're experimental, and we support experimentation, and we understand that as entrepreneurs are trying new things, and as technologists are trying new things, that they have to be prepared for basically anything, because these are highly adversarial environments. Every day that your network is live, there are thousands of people trying to hack you. And then the last thing is, I often say to our portfolio projects, or basically anybody, that all we're doing here is trying to change the fabric of commerce and law and the way society functions and politics and the very nature of the organization. We don't have to take ourselves so seriously about it. Have fun and enjoy this process, even if you're not technical. So even if you're not, say, computer science background, it doesn't mean that you can't get involved with crypto economic systems. So try new things, be open-minded, and have a good time. And so if you have any questions, comments, or want to send me any complaints or anything like that, you can reach me in any of those forums. So thanks very much.
Thank you, Ryan.
Cool.
Okay. So we're starting to receive a bunch of questions on Slido, and while the list keeps getting longer, maybe I'll start with a couple of questions of my own, if that's okay with you. Mm-hmm. So the Web 3.0 will be decentralized, and it will be powered by blockchain technology. What's going to happen to the tech giants that are kind of leading the web today? What's going to happen to Google? What's going to happen to Amazon? What's going to happen to Facebook?
So it's difficult to say. I mean, there could be an argument that some of them come around and are very successful in this next iteration of the internet. History would not support that argument. So the winners of Web 1 were not the winners of Web 2. I think there's a coherent argument that the winners of Web 2 that rely on owning, 90% of your storage, your computation, your personal data. They commercialize your personal data as they see fit. What I've seen in talking with them, we've been fortunate enough to have a number of conversations with the FANGs, is that they're having difficulty fitting this like Web 2 model into Web 3, right? They're like, oh, like how do we, how do these companies make money? Or like how do we extract revenue from this and rent seek on top of these networks? And it's like, they're not really getting that. And so I'm not optimistic that you'll see great success from the Web 2 incumbents in Web 3, but they are smart and well-resourced, and so maybe we will see some successes.
Mm-hmm. So Facebook and Google recently announced investment in blockchain, and mm-hmm. it seems to be a very early stage investment mm-hmm. for them. How come they haven't jumped on the bandwagon earlier than that? They've always been at the cutting edge. Why are they like 5, 6, 7 years?
Yeah, that's a really interesting question, and one that I'm not sure anybody has the answer to, both within Facebook and Google and beyond. The observation would be that they're just not recognizing the impact of this on their core business, or didn't until things like Cambridge Analytica came up, and mm-hmm. people sort of associated that Cambridge Analytica situation with, okay, actually here's a solution over here, which is Web3 technologies, and then they're kind of compelled to do so. Mm-hmm. And that's what you often see, like in cases of innovator's dilemma, which is the incumbent moves in to the new space only when it's so obvious that they cannot they can't not participate any longer. And I think that's what we're sort of starting to see in 2018. But again, to move from traditional economics and traditional business structures into kind of these Web3 crypto economics concepts is a very significant sort of paradigm shift, which I myself had difficulty in doing, and we see this quite often. And what we're seeing when we're sort of jamming with these, with some of the FANGs, is that there's certainly an inertia around their current business model.
Okay, yeah. I lost the Slido page, but I still have a few questions, so there's no emergency, but if I could get some help with this.
We can also take some Q&A from the audience if anybody has, something.
We have a whole
specific they
list
wanna-
in there, but
Sure.
it's just going to be a couple of seconds. Thanks. So my next question was, what we're seeing here is that if we look back at the infrastructure of capitalism, we're seeing change happening. But the foundational infrastructure of capitalism has been very stable for the past 400 years, especially when we look at the financial infrastructure. Since the first central bank was created in 1609 in Amsterdam, we've had national economies organized around one fiat currency with one central bank, with one or very small number of stock exchanges, and we've had this infrastructure guide the rest of the economy, guide how companies get funding, how they grow, how they trade. Is this a fundamental change that we're seeing right now, this decentralization? Is it just a small update to the software of capitalism?
So I think there's two parts here. One, we will see kind of the current central bank systems migrate to digitalizing their currencies and sort of even having like open networks and things like that. And then we see what we get more excited about, which is the fundamental shift that exists beyond these. And that today, the economy that exists beyond, say, central bank oversight is probably somewhere on the basis of like 1 basis point. But that is certainly going to grow. And maybe it becomes, 50 basis points. Maybe it becomes 20%. Maybe it eclipses what we see under kind of current central banks. But we certainly see an incredible delta, an incredible opportunity in these global distributed networks that are permissionless. Anybody can enter or leave at any time to these specific economies that are based on specific exchange of different resources and trust and things like that using cryptographic primitives, and how that just accelerates transactions around the world of all different kinds. And that's how long it takes to get that full shift, I don't know. It's very difficult to predict our space beyond, say, a period of like 18 to 24 months. But we know that that's the general direction that we're going, and that's obviously what's more compelling in the space. So we've had a number of central banks reach out to us from around the world and say, hey, we're trying to create our currency, but a token version of our national currency. And we're like, great, but like we're not going to buy that currency. That's not compelling.
So the Ministry of Industry and Innovation of China recently published, just a few days ago, a thorough report about the state of blockchain. And there were a couple of interesting statistics that were mentioned in that report. One of them was they actually tried to count how many blockchains have been built since the first one, which was the Bitcoin blockchain in early 2009. And they counted 80,000 blockchains built since 2009 in the world. And out of these 80,000, only a few are still active. Actually, 8% are still active. 92% are gone, are inactive or died. And they calculated that the average life expectancy for blockchain projects was 1.2 years. Is it a statistic that sounds like reasonable to you given the early stage of the industry, or is there something we should be worried about?
So my guess is if we took a look at, say, the number of internet companies created over like the first decade of the emergence of that technology, or even say the number of oil companies created in a certain era or different emerging technologies, usually you get this kind of boom of lots of attempts. Like we're seeing this right now with the layer ones. Like everybody's trying to do their Ethereum version X and Y. And the way that we look at it is that is just sort of a necessary process of innovation, and then the survivors will emerge from that. It's difficult to pick the actual survivors. It's kind of somewhere, as you mentioned, kind of a dozen or plus or minus half a dozen. But for me, that's just kind of a natural part of the evolution of innovation, right?
So part of that report was, and it's a very, very clever thing to do, was actually they published the first global ranking of the best blockchains. So people love rankings. We love rankings of the best business schools. You guys love the rankings of the best companies to work for. Like, we're fascinated by rankings. And so the Chinese government published that ranking. Ethereum was number 1. And then the number 2 was Steam. Do you have any comments? Do you think it's a legitimate? And the Bitcoin blockchain, I think, was number 13 in that ranking of the best blockchains.
Well, it certainly makes sense for Bitcoin because it's not evolving, right? Bitcoin's 10 years old, it'll be 10 years old in a few months, and it has not reached version 1.0. So that makes sense to me. And that has been just an inertia around development. Ethereum has been fortunate enough to develop much faster, and so right now I would agree with that it's in the pole position. Just for everybody to understand, Steam, which JP mentioned as number 2, is actually a social network that uses tokens instead of likes around the network. So you exchange actual value to content creators instead of just giving them a like or commenting on their post. That's an incredibly powerful concept. I'm not so excited about that crypto economic model because it's kind of overly complex. But I think that's probably an example of one of two things. Either A, China understands the component of social consensus and social interaction in blockchains and how valuable that will be going forward. And B, probably one of the editors of the report had a fairly substantial position in Steam.
That's a possibility. So you were talking about ICOs and how there's been billions being invested privately, bypassing VCs, bypassing traditional financial intermediators, and invested directly into startups that had issued their own cryptocurrency on their own blockchain or sometimes using somebody else's blockchain. Recently, one of the companies that's basically touted as the main competitor to Ethereum, called EOS, closed a 1-year-long ICO and they raised $4 billion.
$4 billion.
What kind of startup needs $4 billion to get started?
Yeah. EOS is a really peculiar sort of case that I don't think anybody saw coming. But again, in the support of experimentation, we don't know what they'll create. So they're spending a lot of money on philanthropy and things like that right now. They're doing a lot of really interesting innovation. They're actually out there touting that they're ready to raid the best technologies on the planet. So one of our portfolio companies, Definity, which is whispered around to have really the most innovative consensus mechanism that we've seen maybe in the history of the space, is very concerned because EOS goes around saying, we're just going to lift Definity's code base. And we have $4 billion, so we can pay an army of people to do that and copy it. And so, I don't know why they need $4 billion or why anybody does to do a startup, and I don't know what they're going to do with it. I am cautiously optimistic, though, that it's going to push the whole ecosystem forward. So although it's not something that we participate in, and that project is not something that we were in favor of, and in fact, that year-long ICO, I would actually argue, was a year-long unregulated sale of securities, and there will probably be, somebody will have to pay the piper on that one day. Some innovation will be created by that money, and that's great.
All right. So let's move to questions asked from the audience. I see a lot of questions about cryptocurrency prices. So I'm going to try to summarize.
I probably won't talk too much about pricing. We don't discuss it too much.
That's My only question is, I guess, to what extent does it still matter to the state and future of the industry? Like, for instance, the Bitcoin price.
Sure,
Is
so we're
it
down-
still an important thing for the industry?
Yeah, I mean, as it rose to, very high levels clearly last year, at the end of the year, we certainly got a lot more interest and notoriety around the ecosystem than maybe, I think for me, than I had ever expected. I didn't think something like that was going to happen. And so certainly the price does drive awareness, and that drives more people into the space, which again will just push the space forward. So that is good to an extent. However, going back to your first point about how few of these systems will actually survive, we're sort of the opinion that many of these that are worth well into the billions of dollars will totally fail. Some people will lose a lot of money that they imprudently invested at that time. And this is in part why we as a fund manager take a portfolio approach to our investing, because we don't know who's going to win as well. And we do know that those that emerge will be worth far more than what the value is today. So I think that the cryptocurrency market is somewhere around 250 billion today, right now, and the vast majority of the current cryptocurrencies out there will totally fail, and that doesn't matter, because the ones that are coming up and the ones that will survive will create outlier value measured well into the trillions. And so that's why we don't spend a lot of time on pricing. We spend almost no time internally talking about pricing. Like, we didn't say sell one coin because it went under a certain level, or sell it because it went over a certain level. We balance our portfolio, but generally we take very early positions in projects, and then we work with them over the long term. And we just find that to be a more compelling value proposition as an investor, to get in things that you really believe in, teams that you really believe in, work with them very closely. And if you take a portfolio approach along with being a value-add investor, that things will work out and you'll be able to participate in those tokens that create the trillions of dollars of value going forward.
Mm-hmm. So there's a number of questions about what are these tokens really, and what's your view about whether and under what conditions they should be considered to be commodities versus securities, for instance?
So we were, I don't know if I would say fortunate, but we were selected by the SEC early on, kind of last year, to have a really open dialogue about and help them kind of craft their own thinking around securities law and the Howey test as it applies to tokens. And us, together with Coin Center and a few others, were very clear in this clear line that we define as the distinction. If you're selling a token for a network that is not yet live, that is a security, unquestionably. In all cases, that's a security. If the token is live on a network, then whether it's a security or not depends on the characteristics of that token. So if you're expecting profits from the work of others, if you have governance rights and dividend expectations and things like that, probably it approximates a security, which is okay, it's not the end of the world. But if it's something that's used as, say, like a right to work on the network, or used to, say, like pay gas fees for a virtual machine or something like that, probably not such a close approximation to a security. So we're actually fairly confident of where this lands. And when we look at different tokenized projects, we feel like we've got a decent handle on what is a security and what isn't a security. Anytime you're buying anything of a network that isn't live, that's going to be classified as security. You should think about the implications of what that's going to mean for your investment going forward.
So you're talking about how crypto economics was basically something that was born in Canada. How in relationship to this debate about whether tokens are securities, commodities, or something else, what do you think of the current state of regulation in Canada, and how do you see it evolving going forward, and what is your hope?
I'd probably start with the last part, which is my hope is that the OSC and the BCSC take a very proactive approach to try to be leaders in this space. What I am mostly seeing is that they're prepared to follow suit on what the SEC decrees. And what works for America may not necessarily work for Canada, and we do have an opportunity to continue to grow and develop this ecosystem here north of the border. And there's a lot of notoriety, especially around Toronto. There's some great projects here. In fact, we've just been talking with Peter at Blockchain Horizon Games the last few days. Just some tremendous talent here. If we don't have sort of like class-leading regulation in the space, then we're going to push entrepreneurs offshore again. And I'm hopeful, yet not necessarily optimistic, that we can turn the boat and start to be leaders on compliance and regulation, and not sort of followers of what other regulators are setting for.
So I think we have, from what I can see among the questions here, we have a lot of entrepreneurs in the room that are developing tech startups, tech products, and some of them include blockchain systems, which is great. So there's a lot of technical questions. I don't know that I want to spend too much time on these super technical questions.
I'll be around for more than an hour after, so if anybody wants to jam on some technical concepts, I'm make myself available for as long as you guys need.
That sounds great. So there's like a kind of a higher level question coming from the entrepreneurial crowd, which is like, if I'm building a network-enabled product or service, and I want to incentivize my users, and I want to create the kind of incentives that crypto economics can create, where do I start? What's the right path that I need to take as an entrepreneur to design this incentive system?
Well, you're going to probably want to start with what is, say, the resource, that the important thing that's being sort of traded on this network. So, for example, we talked with a really interesting social network just before. And I mean, social networks are trading, the resource that they're trading is attention and awareness through that network. And so when you can start with that and then tokenize that and then try to accelerate network effects at the user level. So if you just have if one person spends a like, that means they lose a like for the other person to gain a like. That's not really a great system, because that requires the users to pay for the system. That's where we can use the block reward and add kind of a subsidy to the system over a finite period of time to kind of bootstrap the entire system. So if, for example, a content creator on a social network, for every 100 likes it gets from other people, which is other people spending, say, fractions of a penny on that person, they also get the same amount from the network itself. Then they're getting more money. It's subsidizing the users' spend, and it's attracting more content creators. The example I use for this is Jenna Marbles, who is a YouTuber. Jenna Marbles makes about $4 to $5 million a year making comedy YouTubes for like teenage girls, and YouTube makes about $70 million from her. And you could very easily create a new social network where you say, hey Jenna, like, why don't you come over here and you can kind of bring your users with you. As they sort of like and contribute to your content, you'll get far more of the value that you create. And by the way, you can share some of that with your power users, with the people who are out there sharing your content and accelerating your content through their own networks. And that creates a very powerful mechanism, both for Jenna Marbles, who's about to make an order of magnitude more money, as well as her users and her fans who don't make any money for accelerating her through their network, and now they can. And so, we get really excited about these systems, but it comes down to focusing on network effects at the user level and understanding very deeply what is the actual resource that we want to trade on this network.
Okay, and identifying failures of the prior incentivization system.
For sure. So I mean, we've already seen crypto remunerated social networks like Steam, which I actually would have considered a failed project at this point. And we can build on those lessons, which we're doing across the space, right? We've made mistakes in the early days, and now these new iterations of projects and networks are trying to build on these mistakes from the early days that we all kind of participated in.
So you do disagree with that ranking by the Chinese government, eh?
Sure.
That was their number 2.
Yeah. Actually,
So speaking of like a failed projects and successful projects, do you have examples of blockchain networks that are already in production and that according to you are like particularly successful? What are the kind of the success stories that people should be looking at? And do you have other examples of like massive failures that we should be learning from?
So I don't think we can point to like major successes where we can say that chain, that layer 1 chain made it, right? Ethereum, I would not say is there. Bitcoin certainly is not. Although there's been, a lot of network effects created, those can be taken away actually very quickly. And because we have digital incentivization, the acceleration of network effects from one chain to another can happen very quickly. So I think we'll see some of these, what we would call successful chains, die in a very rapid pace. So I would not say that we've seen incredible successes at the protocol layer. At the application layer, we've seen some interesting early successes like CryptoKitties. So this is a non-fungible sort of like card that you can trade and has value, and we're starting to see more of these pop up. So I had mentioned Blockchain Horizon Games, which is doing kind of Magic the Gathering on chain, and we're incredibly excited about how we can move forward with some of these applications. Failures we've seen a lot. So I can point to some failures that we participated in very directly. Ethereum's failure to have correct incentives over the long term created a situation where a bunch of us participated very early on, captured way too much of that network, and then most of the people totally disappeared. And now they're like, fabulously wealthy, and they're not doing anything. The people left over actually doing something for the network were so small that the network has not continued to evolve at the pace that we would have expected, or the pace really we paid to get at that time. And that's just, we hadn't designed vesting into smart contracts yet. And now we have vesting in smart contracts. My favorite failure is the DAO. And that was a failure of governance where we couldn't get minimum quorum for even very obvious decisions. So the DAO had more holes in it than Swiss cheese, and somebody put forward, actually Canadian, Vlad Samfir put forward a proposal to put a moratorium on the DAO until we fix all the problems. And we couldn't even get, most people were passive speculators, and we didn't have tools for voting at the time. You had to run command line to vote, and so nobody voted. Everyone just expected it to pass, and like, oh, it's sort of like Brexit. Oh, it'll, I don't need to vote about that, that'll get fixed. And then you wake up one day, and wait a sec, like, it didn't pass, and then it failed in great catastrophe, and then taught us that governance is really hard. And I think we'll see more failures come up, and that's just part of the process.
Do you believe that we'll be able to achieve governance fully on-chain in the near future, or that we'll always need something like a board of directors or like human beings gathering around the table and like discussing issues at least once a year and like making decisions that kind of supersede the code?
That's a really interesting question and point. I am cautiously optimistic that eventually we get to fully on-chain, but I think the way that we get to fully on-chain governance is the melding of the second part that you mentioned, of where people coming around a table and leaders of a community discussing is a valuable component of governance, which then needs to be disseminated properly to the token holders, and then the token holders need to have easy tools to vote or delegate their votes to these people who are more involved in the decisions. And we don't have any of these today. We don't have the voting tools, we don't have the leaders coming around, we don't have the dissemination of information. For example, I sit on the Web3 Foundation board, and it's a group of us that are making early sort of design decisions with respect to Polkadot and Web3. But as we expect governance, we should have that as a more participatory board among the thousands of token holders that are there. We just, we're just not there yet. And so, long story short, as we bring social consensus and tokenized consensus together, and they sort of feel like one and the same, that's when we'll sort of have good on-chain governance.
So we have a number of questions that are revolving around the topic of privacy, especially in relation to the new regulations that were adopted in Europe. Is there going to be an advantage to private versus public blockchain or networks in the future when it comes to privacy?
Definitely. Private blockchains are a meme and are a joke for the most part. Public blockchains, it's like it's like we're in the early 90s and a bunch of banks, sorry, we're in front of a bank here, but a bunch of banks are saying, hey, we're going to have this intranet that just we control, right? It's just our little thing that we control. And just our devs will work on it and stuff like that. And that is not interesting at all, right? The open internet won out. Banks migrated onto that internet and created privacy at the application layer such that they had security, and that worked out very well for them. And I think we're sort of seeing the same thing play out here. So Hyperledger, for example, of IBM, maybe has a couple dozen developers in a few rooms around the world that are very smart and very well-intentioned and working very earnestly. They just do not compare to the 30,000 open source devs working night and day feverishly because of that financial incentive that's out there, right? If you're a dev in open source networks, you can do very well right now. And in fact, the next generation of networks, what we're going to see is that these open source devs who make protocol layer contributions are going to start to get paid more than professional sports athletes. And with Tezos and with Dfinity, where part of the block reward goes to the developers for ongoing innovation, these people, what you're going to see is a dev make a commitment at the protocol layer and then overnight get paid $100 million. And the second that somebody gets paid $100 million over in, say, Tezos or Dfinity, the rest of the world, or Polkadot, I should say, the rest of the world's going to sort of wake up and say, wait a second, like I have technical skills just like that, and I'd like $100 million too. And then you'll get this great migration of developer mindshare and talent to these blockchains that are more elegantly designed to incentivize, intelligent contribution of, design and just engineering, right?
So we have about 5 minutes left. So I have a series of short questions about what's going to happen next. So what's going to be the room for fiat currency in the future where we already have like about 2,000 cryptocurrencies that are exchangeable on online markets, and that number keeps growing?
Well, you'll see a number of central banks become effectively a stablecoin or their own version of a stablecoin. And I think that's acceptable and great. And we're actually already seeing this in many countries. So I do think that there will be a space for central bank-backed currencies in the Web3 economy.
Okay. What do you think of the initiatives that some central banks are implementing today with respect to creating their own cryptocurrency?
Again, it's something that we support generally. We don't invest in and don't find it to be a tremendously compelling innovation or opportunity, because it's just the same thing as a bank, right? You just give your money to the bank, and then they give you this digital token that says your money's over here in our bank, very safe. That's kind of counterintuitive to the crypto anarchist ethic that our space was based on and that our firm is more focused in. But it'll be part of the solution going forward.
How many blockchains will coexist 10 years from now?
So at the risk of being, 10 years is an impossible timeline to predict, especially in this space. We have difficulty predicting 1 year. But I would say it'll be somewhere, somewhere between a half dozen and maybe 2 dozen that are sort of major chains. There won't be just one. That we're very confident of. And there won't be hundreds. That also doesn't make sense at all. As you see these raids and some consolidation, and you see very compelling financial rewards such that certain chains are consolidating a lot of developer mindshare, you'll see some very powerful winners. But one thing I've learned in the last year, working a lot with our Chinese partners, is you'll also see regional winners. So Ethereum or another iteration is just not going to be the winner in China. And by the way, Koreans are also never going to use the Chinese winner. That's just not going to happen from a cultural perspective. And so this is really interesting for us because we're seeing an opportunity to potentially replicate success. So there will be a Korean DAG and a Chinese DAG, and there will be a Korean, governance blockchain and a Japanese governance blockchain. And they won't necessarily all consolidate into one like what we'll see mostly here in North America. So there will be regional winners, but then because these chains will kind of consolidate a lot of mind share, there won't be dozens of winners.
So you explained we were still at the infrastructure building stage, not at the mass market consumer app stage. When will that be the case? When will we all be using blockchain apps on a daily basis and it will be like consumer friendly and user friendly? When will that be happening? How many years away?
Well, it's certainly, I would say somewhere between, it's certainly not in the next 24 months. After 24 months, I think you're going to see some really interesting scaled use cases come out. But this year and next year is really defined by getting the infrastructure in line, basically.
Okay. How can crypto economics and blockchain enabled networks, how can they help in the developing world?
Oh, well, actually, somewhat similar to cell phones, where the developing world kind of leapfrogged, the wired phone infrastructure and went right to cell phones and adopted it very natively. I think we could probably see the same thing for banking with, within the developing world, where people who never had a bank account, their first bank account will be, say, like a blockchain mobile bank account. And that's wonderful because it's an incredibly egalitarian force, right? It'll allow people to, for the first time, enter the formal economy. It'll allow people to save and invest and transact more efficiently than they otherwise could. I spend a lot of time in developing nations, and I can speak at length about how difficult it is to interact with the financial system in some of these developing nations. And Scotiabank, which does a lot of work in around South America, would also know this very, very intuitively as well. And so to the extent that we can make a totally untenable system for these people now function, I think you'll get a lot of adoption that you wouldn't otherwise not have. 68% of people in South America, for example, where I lived for nearly a decade, are either grossly underbanked or have no bank account at all. That's a majority of society. And so these technologies will enable for these people to have the types of banking services that you and I have. And that's just going to enable stronger GDP growth among those communities and more equal societies generally, so which is great. And that's really what we work for. And then on top of that, you're also going to see things like the proliferation of universal basic income, which is totally impossible today, but actually quite trivial with blockchain technologies. And the impact of universal basic income, what that can mean around our planet, there's enough wealth in the world to provide everyone on the planet with a reasonable universal basic income of a couple $100 a month. If we could, say, limit it in certain ways so that a couple $100 can't be spent on the wrong things, and it definitely goes to a unique individual and people aren't cheating the system, and all these things are actually achievable with Web3 technologies, again, very trivially, what we're talking about is maybe like the greatest social impact our world could ever create. We're talking about lifting billions of people out of abject poverty, which is a wonderful initiative.
So my last question will be for the people in the audience who may not necessarily be experts in the space, but nevertheless found your talk fascinating, and there's a lot of questions that are not questioned, but just like, oh, that was awesome kind of messages, so thank you. And want to stay in touch with what's going on. So what are the resources that people want to stay in touch, want to stay up to date, can use maybe on a daily basis to know what's going on in the blockchain space or in the crypto economic space? Because mainstream newspapers are not necessarily like the best source to know what's going on in the space. So what is it that you read or that you would recommend reading or tapping into to stay up to date?
For sure. So the first thing I'd say is no matter what your background is, if you sort of are diligent in kind of developing in this space, you can have a great impact. And so we find people from all kinds of different walks of life who have emerged into leadership positions in this space. For example, I was, in a previous job, I was working mostly in infrastructure that had nothing to do with this space. So don't be discouraged if you don't, say, have like a CS degree or something like that. There's lots of great opportunities in blockchain for all types of skill sets. And we're just, we're really making this stuff up as we go along. Like nobody knows any better than anyone else. We just got to test all this stuff and sort of roll it around in our heads and then roll it around in real life. And it's a really fun process. And so, do get involved if this is interesting to you. As for resources, again, sort of in line with this very like anarchist counterculture that our space was founded upon, the best resources that we find for deal flow are things that are really kind of counterintuitive. So like, Reddit is a really interesting space that I spend more of my time reading Reddit articles than I would, say, blog posts or newspapers. In fact, I don't really read newspapers at all anymore. The best resource that I think I've had in my own sort of trajectory in this space is going to events and connecting with people and learning from people and starting to chart your own course. So getting out to technical conferences rather than, say, like business-oriented conferences, and really starting to like embrace that technical side. Like especially if you're non-technical, embrace that which is the opposite that you're already good at. Because the best people in crypto economics are combining sort of the opposite sides of that star. When someone like understands behavioral economics and gets cryptography, then that person is really, really like dangerous in the space, basically. So to the extent that you can sort of embrace that which you're not good at, and just chart the stoic path of the student, of the apprentice, and kind of get up the curve over time, that's really where you're going to have the greatest impact. And then outside of that, I think probably the best resource for development is actually reading white papers of compelling projects. So if the Ethereum white paper, for example, is not that difficult to read. Read it. The Bitcoin white paper is actually really easy to read. You'll learn more from reading that than you'll learn from 500 posts on a blog like ETH News or CoinDesk or so on and so forth. And as long as people sort of recognize that they're in an apprenticeship phase and it's about learning and not about, say, current events, then getting up the curve is a lot easier.
All right. Well, thank you very much, Ryan.
Thank you guys again.
I have a little something for you here.
Well, thank you.
I'm just going to say a few concluding words, but
Okay, cool.
So thank you so much, Ryan, for this fascinating talk and conversation with our audience. I hope you enjoyed tonight's event. I'm not going to be talking for too long. I just want to mention that we had an event that we had to cancel because of bad weather conditions. And I know some of you were registered and may not know yet that it's been rescheduled. So this is our next event. It's going to be about the future of digital advice and robo-advice in the financial sector. It will talk about the myth and realities of digital advice and what's going to happen next. So you can still register for that event. And of course, you can register for the newsletter on the Scotiabank Digital Banking Lab website if you want to stay in touch with all the events that we're organizing. Thank you so much for being with us tonight. You can stick around. We're not closing yet, but don't stay too long. I don't actually know how much time we have, but we probably have another 30 minutes, so don't rush. Thank you for being here, and see you next time.